Which one of these is the best ultra high dividend yield stock to buy? Is it EPR Properties or is it Medical Properties Trust? So let's begin. So EPR Properties offers a robust dividend yield of 8.25%, but that's still below the much higher dividend yield of 13.03% of Medical Properties Trust. So a really high and ultra high dividend yielding stocks, a pair of stocks here. However, when you have such ultra high yield dividends, it's important to check out the sustainability of these ultra high dividend yields. So that's what I want to do next. So in this next metric, I compare the total dividends paid over the trailing 12 months with the funds from operations per share. It's important when you're looking at a real estate investment trust, the funds from operations is the more informative metric to look at instead of the earnings per share, because the earnings per share also incorporates fluctuations in the value of the properties, whereas the funds from operations excludes that. Okay, so looking at that metric here, I have EPR properties with a FFO, funds from operations, of $4.53 over the trailing 12 months, and a dividends paid of $3.25 over the trailing 12 months. Okay, not so bad, not such a bad ratio for an ultra high yield dividend stock and for a REIT. However, Medical Properties Trust had a dividends paid over the trailing 12 months of $1.16 compared to an FFO of $2. I'm sorry, flip that. It had dividends. No, I was right. Dividends paid of $1.16, while it had a funds from operations of $2.18. What messed me up there is just the scale of the chart here. It has the $2.18 coming below the dividends paid figure here. The next thing I wanted to consider is the overall funds from operations paid for the trailing 12 months, not the funds from operations per share, just the total funds from operation over the trailing 12 months. So looking at that metric, you see Medical Properties Trust showing very nice growth in its fund from operations with the recent fall to 1.3 billion. Medical Properties Trust has had a difficulty with a couple of tenants, namely one big tenant that hasn't been paying up, and EPR properties also have had very nice growth up until the pandemic, where its funds from operation collapsed and is now recovering. EPR properties has a uh, meaningful or heavy exposure to the movie theater industry. So it's got a lot of movie theaters as tenants. And as you might recall, movie theaters were forced to shut down for a long time during the pandemic. And so it had to renegotiate deals, missed out on some rent. And so it's got really high exposure to that industry. And even though that industry is recovering as people are going out again, the movie theater industry overall has been troubled longer term, even before the outbreak. Fewer and fewer people are going out to the movie theaters, and so that's not really an industry you want exposure to if you're investing in a REIT. The next metric I wanted to look at is total assets overall. I want to see, all right, so they're generating funds from operations of 1.3 billion, but that's off of how much assets, right? How much assets do you have? And assets is somewhat a good proxy for property value. How many properties do you have? And how your FFO to total assets tells me how good you are and the quality of your properties and how good you are at generating rent and operating your properties effectively. So we've got Medical Properties Trust with 1.3 billion in FFO and on total assets of 19.6 billion. And then we have EPR with FFO of 340 million on total assets of 5.75 billion. So looking at this metric, um, it looks like medical properties is doing a better job of capitalizing on its assets. The FFO to total assets, it looks like medical properties is doing a better job of that. Although EPR could recover as the movie theater industry continues to increase the amount of coverage and the amount it's able to pay back. I also wanted to consider total long-term debt. I wanted to look at how indebted these companies are as it relates to total assets as well. So medical properties got total debt of 10.27 billion on total assets of 19.66 billion, and EPR has total debt of 2.8 billion on total assets of 5.7 billion. Okay, so not too bad. Roughly 50% we can estimate they've got each got total debt to total assets. And the reason I look at total debt to total assets is in case they get into some really big trouble, they can sell off some of their assets, some of their properties to pay back some of their debt. So that's why you look at total debt, but you also compare it to total assets, and you look at funds from operations too, because some of those funds can be used to pay back debt. I also wanted to compare these two on their operating profit margin over the trailing 12 months. And looking at this metric, I could see Medical Properties Trust has been considerably better than EPR properties, and that's been the case over the last decade. And most recently, 65% compared to 52%. So they're doing a better job overall as a company from taking their revenues and turning them into operating income. So finally, I wanted to compare these two on valuation, and I chose to use the price to free cash flow to compare these two. I could have used several other metrics, but to simplify things, I chose to use the price to free cash flow. And looking at this metric, Medical Properties Trust is slightly more expensive than EPR at 7.184 compared to 6.782. However, I think that that premium is deserved. And if I was to pick one of these two ultra high yield dividend stocks to buy right now, I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. I would pick Medical Properties Trust um, because of several of the things that we discussed in the video. Um, Also because I would not want that elevated exposure to all of those movie theater tenants. I feel longer term they are in more trouble than could be seen right now, because right now they're still benefiting from that rebound in consumers, wanting to go out more and do things outside of their home. So the movie theaters are kind of benefiting from that. I don't know how sustainable that is, right? It's just so expensive to take your family or to go to a movie theater nowadays compared to the other options you have for entertainment. Compared to, you could stream content at home, you can do so many other things that's so much less expensive than going to a movie theater. So I'm concerned about the riskiness of that industry. And so, according to a lot of the other metrics we looked at, so I would go with Medical Properties Trust in this case. All right, so thank you so much for watching. Based on your interest in this video here, I've selected another video that's popping up on your screen. I think you'll enjoy that, so please click on that, and I'll see you over there. Thank you so much for watching.